Welcome to the daily update. This is being prepared Tuesday, June 28th, where we'll look at the action in the market today and then see how things look for Wednesday, June 29th. And there's just one more day to go if you're interested in signing up for the program. And if you don't know what I'm talking about, please look for the video on the YouTube and Rumble channel that talks about the launch of the program. So let's go back and talk about Tuesday. Even though it was a down day, we were down 2.01%. It didn't do as much damage to the charts as maybe you would think it would. So yeah, some of our scenarios, our positive scenarios, are not looking as good now, but the charts are holding up. They're not still turning positive necessarily, but they're not turning over and going negative either. So what happened on Tuesday? At the open, we had a really nice positive open. We gapped higher all the way up to R2 at 39.44. And it looked like, okay, here we go. Things are looking good. Well, what happens quite often when we see a gap higher or lower movement, after that gets done, you tend to see a counter trend move to try to fill the gap. Maybe all of the gap or some of the gap. Well, what can happen is what happened on Tuesday. We tried to fill the gap coming back down by seeing some selling, but then we just kept going. And it just kept going and going and going. And we ended up being down on the day instead of up. So we saw a 3% move in one day. So selling then took prices below the daily pivot, which was at 39.06, and then finally into negative territory. As the day went on, prices fell below S1 and S2. Now, please be reminded, because of the small range that we saw on Monday, the pivot points for Tuesday were not all that far apart. In fact, I had to break out the pivot calculator again just to put S3 onto the chart at 38.30. And we went even below that. So going into the close, we were down over 2%. Volume was below average, but it did increase from Monday. You have a lot of people that are thoroughly convinced that the market's going to go down from here. And so when they started to see prices move, well, they got in. You have other people that think, no, this is just getting ready to go higher. But to see such a reversal, now they had to get out. And so that increased the volume as well. And it's not real clear right now. So our technicals, they're still negative overall. And we're still trying to pick out some positive things that could happen, but they're not looking as positive after Tuesday. Of course, the big fixation is what it has been for quite a while now. Inflation and interest rates, which are feeding over into growth concerns. We have a lot of geopolitical concerns, which are still very important and could come into play, but they just really haven't yet, other than possibly in China, where it looks like the testing that they've been doing has not found any recent COVID cases. And so they're going to start lessening the lockdowns there, and that could help the supply chain issues. Then we look at earnings as they are released. And then this is the big battle right now too, is recession fears. Are we going into a recession or are we not? So what are some comments? The S&P was up 1.2% before it fell and then ended up being down 2%. Consumer confidence is promoting stagflation fears. In the report that came out, it was lower, because people are not having a lot of confidence right now. But when they're looking into the future, they're seeing less hope right now. And they're using that as justification for taking the market lower. And I don't know if that really was it or not. The market just wanted to go lower. The 10 to the 5 yield curve is still inverted. Fear is becoming extreme. And the economic reports that came out, we had consumer confidence. It declined to 98.7, where they expected it to be at 101. So that was a little more than expected on the downside. The advance report, we got a lot of these advance reports. For international trade, it was minus 104.3 billion. For retail inventories, they increased 1.1%, and the wholesale inventories rose 2%. The S&P Case-Shiller Home Price Index, it was up 21.2%. Wow, that's quite a jump in housing prices. They expected it to be up 21.1%, still pretty high, but a little higher than expected. The Housing Price Index, that was up 1.6%, where last time we saw it at 1.6% as well. So that didn't change, but still showing some growth. Our trend is negative and weakening a little bit, but it could be starting to turn to get a little bit stronger because of the down day. The bias, I'm not quite sure what to do with this. Yeah, it should be negative, but it didn't seem to do an awful lot of damage to the charts. So maybe just mixed rather than positive right now, as is the momentum, as the market tries to figure out what it wants to do. Sentiment is now back more into the extreme fear area. And here's the historical chart where the economic policy uncertainty index, this just bounces around like a ping pong ball. It spiked up on Tuesday where it had declined. This is just showing that most investors are more in a risk off type of a situation. And these charts can be kind of hard to read. But when you see most of the dots over on the left, that's risk off. That means bonds or dividends or those kind of investments that are considered to be less risky. When you go over to the right-hand side, those are risk on investments, mainly stocks. And those are the ones where you see the better returns. Well, when we're going down, people tend to get more into risk off. When we're going up, they get more into the risk on investments. This is just showing the Philadelphia Fed survey against the growth rate, not the rate of the S&P earnings, but just the growth rate of the earnings. And the Philadelphia Fed really saw a decline. And we're also starting to see a decline in the growth rate of the EPS for the S&P 500. They sometimes move together with each other. Also, we have the weekly percent changes, just shows that, my goodness, we saw a 6.45% change. And this is what kind of the debate is going on right now too. Usually in bear markets, that's when you'll see your biggest up days. And in bull markets, that's when you'll see some of your biggest down days. Well, we saw a big down day and week last week. So was that just a bull bounce within a bearish scenario? Or are we forming a bottom and starting to go higher? We're not really sure right now. You can make a case for either side. Then looking at the median CPI in the US at the start of 13 cycles where they raised interest rates. And we're looking just where was CPI when they started to raise interest rates, and the median is 2.5%. And then where was CPI when they started to cut interest rates, and the median is 4.4. That's kind of what I got out of this chart. And then the investment grade bond outflow shows kind of what we've been seeing in some other charts, that there's really an outflow of bonds right now. And then this chart I just showed a couple of days ago. This looks at the forward EPS growth for the S&P 500. That's the dark blue line. And then the Fed funds rate. As they start to raise the Fed funds rate, you'll see the growth rate start to decrease on the S&P 500. And that makes sense because companies have to pay more to borrow money, so they can't grow as quickly. Then we're looking at what's really kind of a high spread right now. The blue line here is the 10-year Treasury yield, where it's really going up. The yellow line are the banks, and they tend to move more in tandem with each other. Well, right now they're going in opposite directions. So our Treasury is going to come back down, or our bank's going to go up, or we're going to see a combination of the two here. Then this is the valuation, and it's fallen below the average that still remains above the low during the financial crisis. And this just shows here how we've really come down as far as the valuation is concerned. And I have another couple of charts to show you that. And then almost everyone expects inflation rates to fall. Well, when everybody's expecting one thing, it doesn't always work out that way. But most people here are expecting interest rates and inflation to come down. Then here, this is a Yardeni chart just showing the unfilled orders or delivery times has really been decreasing as they're really trying to deliver things to companies. And the latest came in at minus 8.6. Here, this is the prices paid and received on a regional basis. And the prices paid, it's been decreasing lately, but has really been climbing, where the received, it's lower and has actually gone up a little bit. So we want to keep an eye on that, because companies have to receive more than they pay or they're not making any money. This is looking at the earnings going forward, where the S&P is the red on top. Then we have the S&P 400, that's the mid caps in the middle. And then the S&P 600, that's the green or the small caps on the bottom. And then here we have all of them together, just showing how the EPS has been declining. This is looking forward. This is what the market uses. This is not necessarily what I use when I'm trying to evaluate, is the market cheap, expensive, or just about right. Then we look at the VIX. It bounced up a little bit, but not necessarily as much as you would think on a down 2% day. And the VIX of the VIX, it blipped up just a little bit, but not all that much. The Ulcer Index is still starting to roll over. We're down 20.69%, so we're kind of back into that bear market territory. The equity put call ratio did go up a little bit, as could be expected. People are looking to hedge their investments, and it blipped up a little bit with the 5-day moving average. The bear bull ratio, it actually declined a little bit in the latest reading. Here's the different support and resistance levels. Here are the daily pivots for Wednesday's session. Here's the daily chart showing that we came back down below the pivot level. So we broke through that support. Are we going to keep falling down, or are we going to be able to bounce back up from here? You can see down at the bottom where we did see an increase in volume from Monday, but it's still well below average overall. Here's our machine gun chart just showing the different support and resistance levels. Again, I don't know if this chart's really helping anybody or not. This is that same chart with some of the garbage removed here, just to get some idea. We're coming back down to this retracement level. The high that we set in in March, and then the low that we set in May, this is a fib retracement. We came down and broke through that and now came back up. Well, we're starting to come back down to that level again. And here are the daily pivot points that are good for the whole month of June. They're getting ready to change here. They'll change on Friday with July coming next. Here's the Fibonacci retracement showing that we have some more support still down below where we're at right now, but we have to be kind of careful. This, for the bullish side of things and for the positive scenarios, this really kind of dented what we're looking at. Not so much in the charts, but just the things that we were looking for are just not playing out that way right now. And here it shows that we're down right to this level where we have 2 Fibonacci retracement levels. So this is pretty important support where we closed after Tuesday. Here's the weekly chart showing again that the 200-week moving average is still right at the 50% retracement. We're still well above that based on price, but we're right down at this 38.2% retracement. So we're testing some support. If we get a successful test, that could be pretty positive. If we start to break through this support, that would turn things back much more negative. Our sectors, the ones that have been weak for most of 2022 ended up being weak again on Tuesday. Discretionary, tech, and communication. The one that's been the best so far this year, energy, it did the best. It was up 2.7%. Here's the scooter rating showing that the chart has energy looking the best in utilities. They're into the 90s, where you have communication and discretion now getting into single digits as far as their technical rating. And here just shows what we've seen pretty much all year, energy doing the best and all of the other sectors are down independently from the all-time high. Technical alerts, they started out pretty positive. Yeah, we had some pretty cool things happening, but then as the day went on and we kept falling and falling, these turned negative. The S&P going back below 3,900, and a lot of price damage and some psychological damage too, because people that were looking for things to continue to get better were pretty disappointed. Intraday, the futures were up pretty good, and then we had a nice solid upward move right as the market opened, and it looked really positive right from the start. We went above R1 all the way up to R2, came back, looked like, okay, we're just filling the gap here. Nope, we danced along the unchanged level for a while and then just took off to the races down below S1, S2, all the way down to S3, and pretty much closed at the lows of the session along the lower part or the underneath part of S3. Our trend shows that we saw a little bit of increase with selling, a little bit of decrease with buying, but we're still rolling over with the ADX overall. The Arun's not really changing at all. It's flat as far as the oscillator is concerned. Breadth was decidedly negative, and the improvement that we've been seeing just didn't follow through into Tuesday. We saw more weakness on breadth with the advanced decline ratio. New highs, new lows, still holding up, but we're going to lose this if we don't see some follow through pretty quick. Accumulation distribution also saw some weakness, but we're still slightly above the moving average. Short term, the decision point switched back over to an up signal now, and we have that confirmed with our charts too. The PMO has crossed over positive. We lost the 20-period exponential moving average, so we're back below that now. And here's the rainbow showing that we're coming down to the lower end of the rainbow currently. The force index is right at about the unchanged level. The Swinland trading oscillator has turned a little bit based on price and volume. Where this had been helping us to go higher, now it's starting to get more negative, but it's still positive overall, but turning down. McClellan oscillator is still positive, but saw a decrease after Tuesday. And we saw weakness with the 20, 50, and 200 period moving average study. Stochastics turning down in the short term, rolling over intermediate term, still trying to go up in the longer term picture. Intermediate term, here's where the PMO crossed over positive. We crossed over based on price. We're trying to cross over based on volume, but if we see more days like Tuesday, it may turn and go the other direction. PMO study, working off that extreme positive reading with those PMOs that are rising. The buy signals still continue to go up, and those that are above zero also continue to advance after giving an extreme negative reading. We're kind of dealing with this longer term moving average. Now, we just closed a little bit below it. If we go back to the anchored moving average from the 2020 low, the COVID low that we set, Chaikin oscillator has now turned down where it had kind of been hanging in there more positive lately. And the Chaikin money flow just kind of bouncing around the unchanged level. Volume has really been dropping off, so we're seeing a real decrease in the intensity of volume. The vortex really didn't do all that much. Came down a little bit based on the selling, decreased a little bit based on the buying, but it's still negative overall. Summation index rolling over a bit based on price, but still looking a little more positive based on volume. The oscillators, they're just getting to the point where they could be starting to cross over positive. The slope is crossing, the MACD crossed yesterday, the KST and tricks, they're looking better, but they're longer term, where the PMO that we just looked at, it's crossed over positive, and the TSI is also positive. So we're kind of getting a mixed picture right now with our oscillators. The BPI, it actually continued to show a bit of an advance, and that was picked up earlier in the day, where the prices that we ended up falling to, we've been there before and not too long ago. So the a lot of our measurement tools that we use is not really picking that up. The rate of change did decline if you're going back 50 periods, and the ease of movement rolled over just a little bit. The TTM squeeze is also showing a little bit of an advancement here, even with that pretty strong down day. The Heikin-Ashi is still looking positive, but could easily turn negative if we see more selling. The Kegi chart is still positive. The 3-line break is also still positive, but this could change. The Elder Impulse system has turned back to neutral on the S&P as well as the SPY. And we're still positive with the SAR after getting that first dot down below it. This hangs in there a little more. It takes a little longer for the SAR to change once it finally does decide what it wants to do, where the go, no-go system remains with a negative neutral. Long term, saw a bit of a downturn with the 50, a little bit of a turn with the 150 and 200. Longer term moving average steady, rolling over a bit, going back 200 periods with the rate of change. And this is just a longer term chart showing you all of that. Our special case still remains negative long term. The diamonds are back to neutral, but the Qs have actually switched over to negative with the Elder Impulse system. The Vixen didn't really spike up all that much. Yeah, it went up as you could easily expect, but it didn't really spike up. Does that mean it has more room to go up? Or is it just not really taking this downturn with that much seriousness? Then looking at the S&P 500, the stocks that are above their 50, we started to bounce up out of this, but now we came back down, kind of retreated a little bit with the mid caps and retreated a little bit with the small caps as well. The dollar, it was up, and this is what I was watching early in the day. When we had that positive open, I also noticed that the dollar was up, and usually lately, one of those has to give. Well, it was stocks that ended up having to give on Tuesday, and we're still in a pretty solid uptrend overall. The S&P to the dollar is still hanging out more towards neutral territory. Oil bounced up a bit. It was up 2% to 111.76. The correlation between S&P and oil is also kind of hanging around the neutral level. Gold didn't really do much of anything. The ETF didn't do much of anything. The longer term ETF, silver was down 1.5%. It's really having some trouble these days. And here's the longer term view of that. Corporate bonds did decline based on price. And we saw just a tiny advance with the Treasury bonds based on price. Then the Pring World Bond Index was down 0.42%. We're still pretty overextended with this. The correlation between the S&P and the 10-year getting back more to neutral territory, but still having a slight inverse relationship. The tech sector to the 10-year, also kind of the same thing, more neutral, but still an inverse price relationship. The 10-year to the 5-year still continues to be negative as far as the yield curve. We saw a bit of a decline in interest rates with the longer term maturities, and they were pretty much flat with the 2-year and the 3-month. Our scenarios, what can you say about this? We're still working off this idea that once we saw a spike in the VIX, that sometimes marked a bottom. We're not really seeing that yet. The percent of stocks above their 200 period moving average, it's still bouncing up a little bit. And here's the same chart, just a slightly different calculation of that chart. And now we're seeing a bit of a breakdown now with our rotation scenario that we're looking at. The Qs have rollen over a bit. Discretionary has rollen over and gone under the moving average. Large caps have also rolled over. Then looking at growth and value with the large caps rolling over, mid caps rolling over, small caps rolling over. Is this going to continue? Or are we going to see some improvement in that area? Our trend channel, we're still above that trend channel price range there. The spike, we came back down a little bit, but it's really hard to know right now. Is this a final spike before we get set to go higher. And then here's the S&P to the 2-year yield, which just shows, yeah, they have an inverse relationship, but it's not all that strong. We're seeing nothing from the small cap S&P 500 ratio right now. The staples, they were down less than the S&P 500, so that caused this to spike up just a little bit. Are we going to be able to take out this spike, or is this going to turn and go back down? Kind of in no man's land right now. So what's our outlook? As far as the technicals, we do have some possible positive setups, but they might be going away. If we don't see a lot of this follow through with price action, we're going to have to take those off the table. We'll still watch them, but they're not looking as positive as they had been. Sentiment is back to being extreme negative. On Wednesday, we have the weekly MBA mortgage applications index that comes out, well, weekly. So not a huge deal, but the big one, and not even all that big, is going to be the third estimate of GDP, just because we've seen 2 of these reports already, and it's not the final report. So, but still, that could end up moving the market. We've got all the different geopolitical events, Russia, Ukraine. Things might be getting better with the supply chain issues in China, inflation and interest rates, margin calls if we continue to fall, oil earnings, any Fed speak that might come along, the longer term situation in Japan, and then the recession fears. And that's kind of what we're camped at right now. Most of what I'm seeing, most of what I'm looking at, I guess I just said the same thing, have to do with, are we going to head into a recession? So what are our scenarios? We're down. That's clearly the path that the market's on right now for all the reasons that I just said. And the technicals are not as positive after that strong down day. Yeah, they didn't show a lot of weakness. They didn't break down, but they had been looking a lot better than they are right now. What can help us go up? The technicals need to get better. And some of these possible positive setups, they need to come back into play that we're seeing here, and just a general disbelief that the market's never going to go up again. And so we're looking at pivots, fib levels, previous levels, either highs or lows, to act as support or resistance. And we're not really sideways right now, unless you went with yesterday's reading where the ADX is starting to drop down and look more, it's getting weaker. So then you may entertain the idea of some sideways strategies, but we're still well above 20. So I'm still calling it negative and above 20. So our conclusion then is the S&P is negative, but is it rotating back to growth? We have to put a question mark by that now. Short term, it's negative and it was improving, but is that what's happening? Short term, is that improving? We don't really know. Long term, we're still comfortably negative that way. So thank you. Have a wonderful Wednesday, and I'll prepare the next video after Wednesday's session.